Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over a Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
It's Monday, April 13th. Welcome. Hope you had a nice weekend. Big weekend here on this end. Obviously, Mother's Day was yesterday. So my kids and I were pampering my wife. The usual breakfast and get the breakfast ready. And it was really crappy weather here yesterday. So it was in the mid 40s. Hang on, you know what? I'm going to do something because we do have a global audience. So I'm going to get I speak to so many folks who work off of Celsius. You should be able to do this in your head, but I can't. For some reason, I always get stuck on it. So it was about 5 degrees Celsius. I'll convert for you. So anyway, it was just, was that right? That doesn't sound right. I'm going to double check this. Let me see. FC. I have one of these handy little converters. I like to use that. Helps me out. Yeah, it's about right. So it was rainy, but it was a nice day. Just hung around. Really did nothing. We just watched old videos. When the kids were young, we bought Mom a new iPad Pro. So she hasn't had a new iPad in years. So we got her the Pro with the keyboard, and she was all excited and watching movies and all that stuff. And our neighbors came over, and we just kind of hung out in sweatpants and just bummed around. It was kind of nice. It was great. My wife's very low key, very low maintenance on certain things, but no fancy dinners. We just kind of hang out and chill. So it was good. My daughter had her first high school dance Friday night, and I wasn't sure how I was going to feel about that. Seeing her with the boy, but he was a very nice young man, so that was good. And thank God the drama of the dance is over, because it has been, I don't know, I'm sure those of you have daughters and they're grown now, you've been through this, but we're in the thick of it, having a teenage daughter, and who is wonderful, but also prone to the mood swings of a teenage girl. So the anticipation of the dance and the dresses and the trying the shoes on and dresses and going to the store at the last minute for this, that, and the other thing. It's been 2 months now. And my poor wife, I think she was at her wit's end with this. So, and the stress in the house of leading up to the dance. So I'm glad that was over. She had a nice time. That was good. She had a bunch of girlfriends come over. They stayed. We got them breakfast the next morning. So it was good. It was nice, relaxing weekend. Of course, there was some great hockey. The Bruins just looked dominating. So it was pretty. Why wouldn't they? Boston professional sports, right? The city of champions. It's unbelievable. The Patriots, the Red Sox, the Bruins. I mean, at one point years ago, it used to be the Celtics, but they're struggling. Oh well, they made it to the playoffs. But anyway, so I'm staring at my Bloomberg right now, and I'm seeing the Dow down 579 points, 2.24%. The S&P is down 64 points, down 2.2%. I'm sorry, it's down 55 points, down 2.2%. It's down. Dow's down 4.7% for the month. Still up for the year nicely. The S&P is down 4%. What are the annual numbers? Yeah. And it's still up decently. But it got me thinking, right? I think about the overall market. You think about the noise that comes at you every day, and you think about the big things that are out there that people could be talking about, right? It's the dollar is overvalued, and the other side says, no, it's undervalued. Well, in the U.S., you've got twin deficits in the U.S. and huge deficits around the world in many countries. It's going to lead to financial collapse. Right? You've had this big global central bank experiment with low rates printing money. It's been a decade now. And you've had Some people say the consumer's in great shape. Others say it doesn't really indicate the consumer's not in great shape. The average person isn't. They may be working now, but their wages aren't growing as much as they should, right? The bulls will yawn and say the market's not too overvalued. The bears say it's ready to collapse. Got trade wars on the front page news. $300 billion in tariffs. The U.S., the Chinese are coming back and saying that they're going to go get aggressive. In the U.S., they're trumpeting energy independence. The bulls will say, look at us, we're finally energy independence. A bear might say, shale plays are a Ponzi scheme. Let's see how that works out when you got a couple $100 billion in debt coming due, and they got to refinance that. At what rate they're going to do that? Right, all this newfound oil and gas from the shale plays. Most of them, 2/3 of them, never make money. Some on the bull side will say that China and the emerging markets are changing the world. Consumption is growing massively. Going to consume more stuff, consumer stuff, more raw materials. You got other folks out there saying China's going to blow up. The economy is going to blow up. We've been hearing about it for years. Who knows? On the corporate side, you got tax breaks, right, that help corporations' earnings look good. Was it too little, too late? Right? A bear could strongly argue that, yeah, well, great. Post the global financial crisis, companies didn't really have sales growth, so they cut to the bone, they cut costs, they fired people. And when sales growth didn't come back, what did they do? They went out and borrowed on that very historically 5,000-year low interest rates, borrowed money to go pay back stock, and many quality companies took on a ton of leverage, debt. So now you've cut your costs. Yeah, that helped your margins. You borrowed a ton of money. You went out and bought your stock back, financial engineered your way. So now what? Some will say that Trump, right? Rates are too high. You got to lower rates. If rates were a percent lower, you know how much the growth would be? The flip side of that is, Jesus, rates are too low already. If the economy slows, how do you lower rates, which you normally do to stimulate the economy because they're already so low? When you saw rates start to go up in the second half of last year, the market tumbled almost 20%. Tough spot. You've got TV all day long, business television, business radio. You got podcasts, guys like me, thousands of us out there telling you what our views are. Opinions are everywhere. Twitter. I mean, who knows? Right? I mean, there's so much going on. Now, let's go back to the last downturn. If you go back to 04, 05 time period, I think there were about 9,000 hedge funds. They had about $1 trillion in assets. There were about close to about 9,000 mutual funds at that time. I think there were about 8 trillion in assets there. Back then, if you look at the stocks on the New York Stock Exchange, the NASDAQ, the old Amex, and over-the-counter, if you add the over-the-counter ones that really aren't trading, they're 7,000, 8,000, but really listed stocks, 5,000 stocks. And interestingly, since 97, you've seen a steady decline in the number of stocks, except 2013. It's where each year more companies delist than go public. In I think it was 75, 76, there were 23 listed companies per 1 million U.S. citizens. Today, it's 11 per million citizens. So that means investors have fewer choices to invest in. The National Economic Research Data Board says the U.S. has 5,000 less companies that you would normally expect given the size, the population, the economic environment, and the financial development here. So what's causing that? What's causing less companies? Well, you've got M&A, right? I mean, a few $1 trillion some years. You see these mega deals of $10+ billion, $50 billion, $80 billion. And you don't have enough IPOs coming out to replenish that pool. So there's less diversity to choose from. Now, in the recent IPOs that have been coming out, right, these unicorns, Uber, Lyft, getting hammered. That's interesting because you're seeing unicorns, right, the Silicon Valley unicorns. billion plus, which is nothing, chump change now, but it used to be that was your goal. And when they come public, right, they'd soar. But now these stocks are going nowhere fast. Another thing that's hit the market is private equity. It's hit the listed market. Tougher regulations. It makes it much more difficult for smaller companies, much more expensive for them. They'd rather go private. We know Elon Musk would rather go private, right? 420, funding secured. So for bigger companies too, some people just like to be out of the public spotlight. But if you go back, let's think about that. So if we go back to right before the last global downturn, you had 9,000 hedge funds, 9,000 mutual funds. Today you have about 10,000 hedge funds. But those 10,000 hedge funds have about $3 trillion in assets. You have about the same number of mutual funds, maybe a little bit more than 9,000. They have about 18 trillion in assets, up from 8. So hedge fund assets have tripled from 1 to 3 trillion. Mutual fund assets from 8 to 18. Right, so there's a lot of capital swashing around, but the same number of people. But let's think about that. So let's round up 20,000 mutual funds and hedge funds. We're not counting the long-only shops and the financial advisors, registered investment advisors. But every one of them has a presentation deck telling investors how they have really smart portfolio managers and analysts, and they're all able to identify mispriced securities or trends that other people aren't seeing. I think I was watching CNBC, I think it was, and Kathy Wood from ARK Investments, who's a big Tesla bull, she was saying that her analysts understand Tesla better than anyone. That's their edge. I mean, that's laughable. Okay, so the most watched company in the world, you understand because you have different platform teams, robotics, artificial intelligence, whatever you call it. You look at that and understand it better than anyone. That doesn't happen in investing in companies like that. What happens, I'm not to go on a tirade there, is she and others who believe the bull case there are subject to what's called thesis creep, where I owned it for reason X 2 years ago, 3 years ago, a year ago, and now reason X didn't happen, but now there's reason Y. Now reason Y doesn't happen, and now it's reason Z. That's why. But you have all these people. Now let's say, 20,000 hedge funds, mutual funds combined. I don't know, there's at least several 100,000 people, analysts and portfolio managers, at least. Right, big mutual funds. They all have every mutual fund has a portfolio manager. How many analysts do you have? I don't know, 10, 15, 20, pick it. But you got several 100,000 eyeballs looking for alpha, how to generate an edge, how to be different, looking at those same 5,000 stocks. Or today there's 4,000, not 5,000. Right? Is it any wonder? So you have all these same people looking at the same number of stocks. How many think of the ratio of people to stocks? Is it any wonder that over 90% of mutual funds don't beat an index and hedge funds have struggled, especially in a roaring bull market because they have short exposure? There's too many people chasing too few good ideas. And that's what you get and hovering around consensus expectations, and you get mediocrity. Really smart people, but the odds are stacked against them. Add to that the quantitative models, the quantitative trading, add that to the mix, focusing, and then the funds, what winds up happening when you got all these presentations out there and you tell you how smart they are, people become so short-term focused and the volatility creeps up and the day-to-day performance, and it's noise. It becomes all noise. And that's why the vast majority of money managers don't outperform. And who knows, right? Who knows? On this podcast, I don't talk about, every once in a while I'll give an opinion, but I have no idea which way the market's going. Do I have a view? Yeah, I think markets are are tapped out? Do I think there's more downside than upside? Yep. Do I talk about risk on, risk off? Yep. Do I think that means to be cautious, say what you own? Do I talk about that occasionally? Not, or infrequently, but on a rare occasion? Yeah, I do. But to sit here and talk to you about the trade wars and talk to you about the dollar and talk to you about energy independence or talk to you about the tax breaks or talk to you about the rates too high, what's going to happen? I mean, who knows? There's a lot of people looking at it. So how can you outperform or try to outperform? Give yourself a fighting chance and not be part of the crowd. That's why I like to look at things that people aren't looking at. I like to pay attention to where there's few eyeballs, to where the competition to find the mispriced security isn't as great. And that's where most people aren't looking. That is in the bowels, in the things that aren't working, in the things that have been left for dead. Right? There's a great saying by Howard Marks in From Dare to Be Great 2. Howard Marks of Oak Tree Capital, great distressed investor, great writer. He says, most great investments begin in discomfort. The things most people feel good about, investments where the underlying premise is widely accepted, the recent performance has been positive and the outlook is rosy, are unlikely to be available at bargain prices. Rather, bargains are usually found among things that are controversial, that people are pessimistic about, and that have been performing badly of late. Think about that. Most people don't want to be involved in that. Right? In this world, I think to really generate outsized returns, you need to be early, you need to be right, and you got to occupy an unpopulated space. So how do you do that? Well, first off, you have to accurately embrace a non-consensus opinion. And I say accurately because many times things are priced where they should be. Right? So your work has to be accurate. But a starting point is to look where there's a non-consensus opinion. In my life, in my world, that's a very unpopulated space is uranium. I suggest that, and I do so with great confidence, that as of right now, many hedge funds have no idea they can own physical uranium. Most haven't even thought about uranium, if ever, for years. Commodity from peak to trough was down over 90%. Number of companies disappeared. There's very little institutional ownership. Retail investors, they've kept the companies afloat, as you've seen them decline from over 500 to 50 companies through dilution and private placements and capital raises to keep these companies afloat during a bear market. But most institutional investors, and that's changing. I mean, as I run a uranium fund and mostly institutional investors, and I see the level of interest has increased quite a bit. But the difference between interest and committing capital takes time. Why? Because people don't like that discomfort that Howard Marks talked about, right? Most great investments begin in discomfort. If you go back to what I said earlier, most of these managers, they got to perform right away. They like to see things that are moving, that are going in a positive direction. Even a hedge fund, which is much more likely to have a contrarian bent than a long-only mutual fund, still needs to perform. The pressure is great, generating high fees. They have to outperform. They have to try to outperform. So it helps. So they can't arbitrage time. They can't let time necessarily be their friend. Some can. the smaller ones, right, the more esoteric ones, or the really big established ones that have great reputation with investors and they're willing to give them time. But in industries like uranium, where the size of those funds, the multi-billion dollar funds, really can't invest at this point in the cycle too much money, if any, into a uranium company, with the exception of a Cameco or because of it's bigger. But most of the companies are too small. So if you're running a fund of, $3, $4, $5 billion, and a 1% position is $50 million if you're running $5 billion. That's the market cap of many of these companies. Most of the funds don't want to own more than 10% of a company, right? So it eliminates most of these funds. But over time, that will change. As market caps change, as the fundamentals become more apparent and they start coming to the surface, what's happening and brewing below the surface right now is that starts bubbling up above the surface. And that will start to get more people buying, and the market caps increase, and then it kind of snowballs from there. But then you take uranium and take it to the next step. You want to have a little fun? This barbecue season is coming up, right? Summer's here, getting the grills fired up. I got a lot of work to do. One of my things isn't working, but we'll figure that out. But ask your friends, do a little word association. Ask them about nuclear power. See what they say. Your non-investing friends, or even your investing friends. Like I said earlier, most of them probably don't even know about it. But ask them about nuclear power. See what they say. 3 Mile Island, Chernobyl. Some might say Fukushima. Some are going to say, do we still have nuclear power in the U.S.? They don't realize it's 20% of the electric grid. Others are going to say nuclear waste, dangerous. Others are going to say, oh, wind and solar are killing it. All perception. Not fact, but perception. Right? They don't know about the safety record of nuclear power. They don't know that nuclear waste is managed. It's probably the best waste stream because it's captured. All the other stuff winds up in the air. Coal, that waste stream, the particulate matter kills 7 million people a year. Solar panels, they wind up in the electronic waste stream. There's no plan for that. Lead, cadmium, other nasty chemicals. They don't realize the massive footprint. A solar farm requires 450 times the amount of land than say, Diablo Canyon in California, than a nuclear power plant. It's not front and center on people's mind either. When 500 companies have shrunk to 50, the market caps are small. So they don't need to know about it. But they do, but that's good, right? Because you get the opportunity to really understand the story and to try and triangulate and think about it. And think about without thousands and thousands of people staring at it and the day-to-day noise. Because that comes. But in industries that are left for dead, when the fundamentals start changing, there's no better place to be. Because what happens is, in bear markets, apathy kicks in. Both investors and industry people. Right? When you're mired in a you're going to work every day and it's doom and gloom. Think about that. That's been that way for years in the nuclear power industry. After Fukushima, the 54 Japanese reactors came offline. It oversupply, right? Caused people to rethink their plans. Now, at the end of the day, fast forward 8 years since Fukushima, and I would strongly suggest that nuclear power is undergoing a very, very encouraging renaissance. Most days or weeks or months, there's something positive that's occurring. A country that was going to reduce dependency on nuclear power is now kicking that out a decade. Countries that have it are increasing their exposure, or new ones are coming online. That's the demand side. There's a huge amount of reactors under construction, 50, now it's 54, 55. Hundreds in the planned and proposed stage. Why? Because if you need baseload, always on, reliable, purely carbon-free, safest form of electricity generation, again, people don't recognize that, there is no substitute for nuclear power. You can have wind and solar, which delivers 10 to 30% of the time. That's great. Don't get me wrong, right? Where it can work, where sun's always shining, but even there, where you have the great environment, sun's it goes dark. There are places where the wind doesn't blow, and it costs too much to store it. Yeah, I know storage costs are coming down. It's not close. So there's a really compelling, and I'm not going to dive into it. I have stuff all over the internet. If you want to learn the demand side, the demand supply, Google my name and uranium, and you'll see it. But there's a very compelling demand case that people tend to ignore when you've had oversupply, like you've had oversupply, and because of the Fukushima accident back in 2011, in March of 11, and it just caused, when those reactors came offline, it caused a slowdown in people's thoughts, people's plans, and demand. But like anything, supply, demand, and that's why when you're looking for out-of-favor industries, in these deeply cyclical industries, there's no better hunting ground. Because as the saying goes, it was actually Aubrey McClendon, the former CEO of Chesapeake Energy, who basically said, cure for low prices is low prices. Now others have run with that. But in these industries, that's what happens. When the cost to produce something goes below the cost that you can sell it for more than a reasonable period of time, you have to cut supply. And that's where you're at now in the world of uranium. And you're seeing massive supply cuts the total supply is far below production or supply is far below demand. You might see 130 million pounds of supply. This morning, you saw more news. That's primary supply, by the way. You saw more news, though, one of the big French nuclear giant, Orano, they're going to be closing one of their mines in Niger, producing 2.5 million pounds a year. Earlier than people thought. So if you have 190 to 200 million pounds of demand, and that's going to keep growing, and you produce 130 to 135 million pounds, well, the rest is made up of secondary supplies. And lo and behold, those are starting to decline. I strongly believe that they've peaked and are receding and will continue to do so at a more rapid pace. And when you add it all in, the hopper, primary, secondary, pull down the inventories, which people incorrectly think are high because they look at the total number and not the actual number that matters from a commercial standpoint. You have a deficit of uranium, and it's not little. I don't share our exact numbers because those are proprietary. But one of the things we like to do is look at buying behavior, right? One of the things I always implore people when you're looking at these industries, when you're looking at out-of-favor industries and things look so bad, I often say, right, and this is not me, but I borrowed it, but it's true, right? While history doesn't always repeat exactly, it often rhymes. And in deeply cyclical industries, human behavior is human behavior. It doesn't change. And when you look at, so you have to understand you're dealing with humans who are either euphoric or depressed in their industry. When you're in these deeply cyclical industries, it's either really good or it's really bad. And there's this recency bias that I can't, and I speak about it a lot, I can't overemphasize it. People extrapolate what has recently happened. And industry participants, whether they're in the production, they're engineering, they're building, they're buying fuel, they all are susceptible to that. And so you need to understand when you're looking at these things, when you start looking at industries, understand who are the people buying the stuff that the company you're looking at is selling. If you're looking at a commodity company, who's the buyer? And what's the most important thing to the buyer? Is it the price he pays or something else? If you're looking at the world of uranium and nuclear fuel, you have to understand what's the most important thing to a fuel buyer. Well, I am highly, highly confident that a fuel buyer at a nuclear power plant is not going to get fired for the price he pays for his uranium. He is going to get fired, or she's going to get fired, if they don't have the uranium under supply. If they don't have it. You can't run a nuclear power plant with anything but uranium as the feedstock. So security of that supply is the most important thing, period. And uranium's interesting because if you look at other forms of electric generation, whether it's coal or natural gas, the feedstock there can be 80 to 90% feedstock, meaning the coal or the natural gas. How much is that as the overall operating cost of the facility? Well, in the world of uranium, the whole front end of the fuel cycle, from mining to converting it to enriching it to fabricating it into these little pellets that go into the fuel rods that go into the reactor, that's 20-ish%. The uranium, depending on the price, is low to high single digits versus 80 or 90 for the others. And oh, by the way, you're producing clean, safe, reliable, always-on energy. So, but what matters is not the price they pay. Now, they will say it is because that's their job, right? But one of the things I learned, and one of the things I really implore you to do, when you're listening to a podcast or you're listening to TV or you're listening to the radio for your to enhance your education on investing or to find ideas, don't listen to the host. Don't listen to me. Do your own work. The best thing I can do is point you in a direction on where to look. But you shouldn't just trust what someone says. You don't know me. You don't know. I try and let you know me. I try and give you insights into me, but trust but verify. Double check. Do your own work. But I could try and give you the tools, right? If you're a professional investor, you're listening to this going, yeah, okay, I know. I do this every day. Okay, but many people listening to this aren't. So, and actually, you know what? Most professional investors don't do it. They get on the phone with a buddy and they see what they like. So, sorry, professional investors. I know your game. I'm one of them. But actually, I and others who are looking at opportunities like this, at least that I know in this space, are not doing that. So what I would suggest is understand if you're looking at nuclear fuel, you're looking at uranium, looking at junior miners, physical uranium, nuclear power, understand what the buyer's mindset is, what motivates them, what's important to them. It is security of supply. So how do you do that? Well, it's work. It's hard work, right? Because there's not anything out there that says, okay, let me Google what's the most important thing to a fuel buyer. No, you got to immerse yourself in the industry. Right? You got to understand what's the history of the industry. Nothing is better than reading and getting on the phone, cold calling people. Now, I understand you have full-time jobs that might not be available, but there's other things you can do. You can find an annual report for Cameco, the leader in the industry in the West. All right, go back to 1999, 1998. Go before the last turn. The price of uranium went from, $9-ish in 02 to 137 in 07. So what led up 2000, 2001, 2002 annual reports? Read it. It's going to take time. What was the tone? What was the tenor? What was the management commentary at the time? What did the chairman's letter say? What did the CEO talk about? What did they put in their management discussion and analysis? What were the key drivers? What were they worried about? What did it say the next year about the prior year that you had read about? Is it consistent? Did the industry change? What caused it to change? Well, in the case of uranium, right, you need to learn about how uranium is bought. What's the market like? Kind of unique. There's spot volumes, but most of the stuff is done on long-term contracts. Historically, right? Historically, most of the stuff that is bought is done on a long-term contract. So understand that when you're thinking about it. What percentage of what's bought is bought on contract? What percentage is bought in the spot market? Do that for each year. It's not impossible. You can do it. It's in all these annual reports. They're not going to say it like that, but they're going to tell you how many pounds, what the industry numbers were like, and you can pull it out. You think about that. How many pounds were bought in the spot market? What was the spot price back then? Each year, you could find it. Again, you got to tease it out. You got to pull it out. What was the percentage at the peak bought in the contract market at peak pricing? What was the percentage bought at the trough pricing in the contract market? Same thing with spot pricing. What was the average over those years? What was the ratio of how much they bought, they, being the industry, globally, how much was bought to how much was consumed in a year? Understand the fuel cycle length. In the world of uranium, it's 2 years, 18 months, 24 months. From the time you order it to the time you get it. So if you were to look at uranium, nuclear power, and you're analyzing the industry, say how much did they buy to how much they consume, right? Come up with your own ratios. Well, in 2002, the price of uranium was $9.60, and it went up to $13.40. In today's dollars, that's $13.40 to $14.25. And the total pounds bought to the total pounds they consumed was 0.5. In 2003, the price of uranium went to about $10.20 to $14.50. In today's dollars, 14.5, 14.25 to just under $20. Bought to consume was 0.5. In 2004, started to go up, $14.50 or $19 in today's dollars, up to a little under 20 to $21 or about $27 in today's dollars. And lo and behold, 0.6 was how much they bought. So went from $9.60 to $20, and how much they bought to how much they consumed went from 0.5, 0.6. In 2005, it started to really climb up to the low 30s. I got a little nervous. That ratio went to 1.5, bought to consumed. In 2006, I'm now talking averages, started spiking up to around $50, 1.4, bought to consumed. 2007 went as high as $137, prior average around $80, 1.45. So when the price is low at 9, they're not buying. When the price is at 137 and averaging in the 80s, they're buying 1.5 times what they consume, but at the trough, they're buying half of what they consume. So they're not bargain hunting. When they can buy it at really cheap prices, if costs really mattered, if prices really mattered, and they did their own analysis and said, look at this, my God, this is on sale. We know that time, and at the time in 2003 or 4, there were 430, 435 reactors. There were 22 under construction. There was no new mine supply coming online. Or I'm sorry, there was a lot of new mine supply coming online. But they didn't. In 03, 04, you had a flood. People started to get nervous. And interestingly, 73% of what they bought, about mid-70s in 02, was under long-term contracts. And when it was peaking, it was 93%. They couldn't buy contracts fast enough in 07. They couldn't secure them fast enough. They went from buying 75 million pounds in 01 to 245 million pounds in 07, 06. Now do that. Now look at inventories around the world, not just the US, Europe, and the rest of the world. Who's buying? Is it reasonable, within reasonable expectation? Yep. But you have to do that work. How much is strategic? How much is in the government stockpiles that's not hitting the market? How much is in the US? How much is in Western Europe? How much is in the developing markets? Piece together. There's Japanese utilities that are public. There's Korean utilities that are public. The Chinese, they're basically state-owned, but they're public. They're speeches that they talk about. They have filings that are out there. Understand the environment at the time. What were U.S. utility inventory levels then versus now? Was there anything that was changing, anything that was different, anything that assured supply during that time? You know what assured supply during that time? To upwards of 20-ish million pounds a year for a U.S. utility, up it from 93 to 2013, was the megatons to megawatts program, where the Russians downblended 22,000 intercontinental ballistic nuclear missiles from highly enriched uranium to low enriched uranium, and they took it into the U.S. shores. But even during that the surety of supply of that coming in, they couldn't buy uranium fast enough as the price was going higher. Couldn't do it fast enough. So look at it where it is today. What's the environment like today? What's bought to consumed? Yeah, a little under 1. Troughed at 0.63. Interestingly, back in 03, about 13% of what they were, about 13% of what they were buying was in the spot market. Went up to 17%. Now it's at half, 0.49 of the demand is in the spot market. Now think about that. Today you have 54, 55 reactors right now under construction. At 12, 13, 14, 15 hitting the grid next few years per year. Each initial fuel load is 3 times. We use 2 in our model, but it's 3. Each reactor on average will use 500,000 pounds of uranium a year. We use 450. So we intentionally know we're low because we're being conservative. So a new 1 gigawatt reactor is going to use 1.5 million pounds on an initial fuel load. So think about where the industry has put itself right now. You've had massive supply destruction. Now, people will say, don't forget, there are financial buyers that have entered the market that could have bought uranium and taken it off the market that could sell it back in. Sure they can. Yellow Cake has bought 9 million pounds. Uranium participation, 12, 13, 14 million pounds of inventory. I'm working off of memory and ballparking. They're not run by fools. They're not trading uranium to make a few bucks. They didn't put these vehicles together to make a few dollars. I don't know what's the right price that comes into the market. 60? Because I know the miners need 50 to even be incented to even think about putting projects online that are going to take a few years to build. And they need to have contracts in hand, because you're not going to get those mines built without the contracts. And those contracts have to have at least a 5 in front of them. Many are going to need 6 in front of them. And why do those projects need to get built? Because nuclear power is a growth business. You can read a headline here or there. Somebody's reducing, a reactor here or there closed. Put it all in the hopper, though. How many new builds? How many relicenses? How many existing reactors? Go draconian on closures around the world, country by country. It's a growth business even when you do that. But the utilities have put themselves globally in a position where the highest point ever they're buying in the spot market, 0.49 in 2018. But the pounds they bought was in spot. At a period of time where supply is coming offline, the biggest mine in the world, McArthur River, came offline at 18 million pounds a year. So the price of uranium sits at what, 25, 26 bucks? Just in their updated 43101 technical report, they're basing it on $42, $43. They're not bringing that online unless it gets there. And Tim and Grant, who run it, smart guys. You think when they could get a $43 contract, they're not going to hold out for more with all the leverage they have on the market? These guys didn't fall off a turnip truck. They have a lot of catch up to do for the industry that's been pounded for the last 8 years when cash flows have imploded. Not their fault. They're not there just to make a little bit of money. They got a lot of catch up. And other projects that could come back online that gets referenced? Yeah. $60. Is that the right price? And it's amazing when in these deeply cyclical industries, well, when you're trading at $25 and you're thinking 50, 55 is the number that you could come back online. Well, it's funny how human psychology comes into play, because when it gets back there, all of a sudden that number changes. You're going to hold out for more because you can. Why? Because the buying behavior of the buyer dictates that. They show that. They buy at peaks and don't buy at troughs. And when they were fearful, they buy more. And in a period now where you have the most number of reactors hitting the grid in a long time, and bigger reactors, you have closures. You're closing smaller ones, you're bringing bigger ones on. Net, you've got growth. A lot of it. And for this demand that's coming down the pike, you need new projects. So you have primary demand that far trails, primary supply that far trails demand. You have secondary supply that is receding. I'm not going to get into a discussion on underfeeding, but you can look it up. I've talked about it. You could listen to conversations I've had on the podcast about it. But that's receding. And the biggest thing is uncovered demand when you're looking at this industry, or any industry like that that's contract-based. How much of the needs of the buyer is covered by a contract within the prescribed length of the cycle of purchasing? And in this particular case, if you were buying uranium stocks in 13, 14, 15, there was no uncovered demand. There was abundant supply, and the utilities were covered by contracts that lasted 7, 8, 9, 10 years. There was no reason for them to buy uranium. That's an entirely different ballgame right now. It's 18 to 24-month fuel cycle. You're upwards of 20 percentage points, 20% of needs that are not covered by contract within 2 years. And that ramps 70% range over the next 7-8 years. That's a big deal because it could take a decade or 15 years to get a mine licensed, permitted, built. All these development projects, most of them still need a lot of work. Many of them have been shelved. Huge amounts of capital that will not get financed unless they have contracts in hand, and many of them with at least a 5 handle, meaning 50 plus. So you have a lot of work to do on the price front. And all the while, those projects that are sitting there not getting built means more supply destruction, means less supply to meet demand. And when you add up primary and secondary, it's not enough. And what will happen? If you lay it out, what's the focus? And inventories are drawn down, not at bare bone levels, but at very reasonable levels. And what's the one thing a fuel buyer needs? He needs uranium, or she needs uranium. And she will pay, or he will pay, what they need to pay to get that uranium. And as long as they're paying the same as everyone else amongst their peer group, that's okay. Now, going back to what I said earlier, think about these things in terms of how many eyeballs are doing this right now. How many people are paying attention to an industry that, A, in the public perception is wrong, but it's not well liked. B, people in the industry are apathetic. They're beaten up. They're all relying on the same data. That data is stale. And when you're looking at industries, understand who the data producers are and what motivates them. Is it stale? Are there handcuffs on how they could report it? Are there other reasons why they might not want to stick their neck out? Do they want to have a baseline, a high case and a low case that you could drive an ocean liner through so that you can gravitate towards whichever one it happens and say, as we said? Understand how consensus is formed. So understand how consensus is formed. Understand the incentives and the motivations of the buyers. Understand the psychology of the industry, the mindset, the mood. And then do 4th grade math. Open up a spreadsheet and do that and come up with your own ideas. Pounds bought, pound consumed, how much bought in the spot market versus long-term market. Put up little graphs, look to see when were they buying the most. Were they buying the most at peaks or troughs? History repeats. It rhymes if it doesn't necessarily repeat. When you do that, you start to put a mosaic of information together. And I go back to Howard Marks. Most great investments begin in discomfort, but bargains are found in things that are controversial, where people are pessimistic about, and they've performed badly of late. The way I view these things is you could slug it out. Is the dollar overvalued, undervalued? What's going to happen with the twin deficits? What is going to go on with the trade wars? Tax breaks going to help. How long is that going to last? Let me turn on Bloomberg and see what that guy said. What's CNBC saying from a guy I have no idea about? Is he talking his book or is he not? Let me and the other 20,000 combined mutual fund and hedge funds and hundreds of thousands of analysts all looking at the same shrinking pool of potential companies to look at. I'm going to go figure out a way to do it. I'm smarter than all of them. I call bullshit on that. I just don't find value in that. Because when it turns and it goes down hard, how are you going to know when to get off the caboose or off the train? How are you going to know? Now, what I'm perfectly willing to do, and this is where I look at risk reward. What's my risk What's the reward I can get for the amount of risk I'm taking? If I have to wait a couple of years and I have 10, 15, 20% downside, but I have huge upside, that's called asymmetry. Who cares what happens in the near term? But it all goes back to you got to be right. If the work is wrong, it doesn't matter. Right? So you have to have a non-consensus opinion that accurately embraces it. You got to be accurate. That's where you see, I see on Twitter a lot, footnotes first, but as a uranium publicly visible person in uranium, I see a lot of traffic, a lot of stuff comes at me. And I see commentary, and it's daily, it's constant, it's all day. And the traffic on there. The more work you do, if your work keeps validating, and you keep an open mind to where you could be wrong, and you have to take into the many areas you can be wrong, and I've talked about that ad nauseum on prior podcasts about uranium. You're not susceptible to the daily whims of if the mood is down and the stocks are going down or they're going up. Whatever it is, you kind of let your fundamental work take over. So do your own work. But nothing beats reading historical commentary. Nothing beats it. Because like I said, in these deeply cyclical industries, unless there's been a change, a step function change. Now, if you're looking at the oil and gas industry in the U.S., right? You're looking at the shale plays. Technological change has changed everything. Right? In theory, the U.S. has become energy independent because the shale plays produce so much oil and gas. Well, then you have to ask yourself, if you're looking at that, well, if 2/3 of the companies can't make money and they owe a few $100 billion, and no matter what the price of oil is, they still shit the bed from an earnings perspective, how long is that going to last? But you got to be cognizant of what's going on. But anyway, so that's my view. And what brought that up, what triggered, is I was looking at the futures this morning as the market was getting hammered. Yeah, look at that, Dow's down about the same. And I thought, I don't really care what the market's doing because I'm looking at other stuff. That's, on a day like today, it's going to get hit. It's going to get hit. But what's going to happen? What's going to cause people to go, holy crap, look at this. I hadn't noticed that. I love those ideas. Anyway, that's all I got. I am not going to be doing a podcast on Memorial Day. I'm going to just take a little time off on Memorial Day. I'll put one of my prior ones up. And this week's an interesting week. Mike Schellenberger, the global nuclear power activist, is who, if you don't follow his work, you should. He's Environmental Progress, and you can find him on YouTube. He's given so many TED Talks. He's fantastic. And he used to be a anti-nuclear, pro-renewables activist for a long time. But he changed his mind on nuclear power, and now he's an outspoken advocate of it. But he's getting about 20 people together at his office over the next few days in California, and I was one of the invited few, and so I'll be out there this week and learning and sharing, and I'm looking forward to that. So I'll be back next week. It's Chatham House rules, so you can't attribute who said what. It's not that I could come back and report on what I learned, but I'll take that body of knowledge and incorporate it into my views. So anyway, I'll see you next week, and have a good rest of the week, and take care. Thanks.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.